Okay, good evening. Welcome everyone to the Thursday evening edition of the Anderson Report. I am Tim the Source Anderson. This is my YouTube channel. I am also on Periscope at TJ Anderson 12, and my Twitter handle is TJ Anderson 1. Very interesting day for the markets today. The markets started off down anywhere from 1 to 2%, and all the major averages rallied, really showed their resistance and rallied about 1.5% off their lows of the day. The Dow had the worst day, down 0.85%. It was down as much as 500 points. It closed the day down about 225. The Dow is up 1.9% for the month with one day to go. The S&P 500 was down as much as 1.5%, maybe a little bit more, closed with only a 0.4% loss. The S&P tested the 3,200 level again today, twice during the first hour of trading, got to 3,204, 3,206, closed at 3,246. Hi, Jen. Closed at 3,246, down only 0.4%. The S&P 500 is up 4.7% month to date. And if there's any indication on from how the S&P is trading in futures are trading after market hours following the earnings release from those four big tech companies, the S&P is up another 15 handles. That's 15 full points. So that would be about almost 0.5% gain just going into tomorrow morning. The NASDAQ was down as much as 1% early in the day. It finished up nearly 0.5%. The NASDAQ went out at 10,588. It was its fifth highest close ever. The NASDAQ is up 5.2% for the month. The Russell 2000 really had a very impressive day after gaining 2.1% yesterday and posting its first close above 1,500 since early June. The Russell only lost 5.5 points. It was down 0.4%. The Russell's up 3.7% for the month. The breadth of the market held up fairly well today. Actually, decliners led advancers by just over 2-1. And on the NASDAQ, there were about 4 decliners for every 3 advancing issues. So the breadth still continues to act well. And keep in mind that unlike Tuesday, when the market sold off sharply in the last hour of the day and the advanced decline didn't really have a chance to catch up on the downside, today the market was very weak. And we had very negative headlines and some bad optics coming into the opening at 9:30. We had the GDP report, which everybody knew was going to be a terrible report, but still to see those headlines down over 32% in the second quarter, it was just a rough opening for stocks. They really showed their resilience by recovering anywhere from a half to 2/3 of their losses from early in the day. And in fact, the NASDAQ ended up closing the day positive. So the energy sector got hit quite hard. It was down 4%. It's had a pretty good month. Financials were down 1.8%. The yield on the 10-year did go down to 0.55. I've mentioned it before. I'd really like to see that yield go higher. I'd certainly like to see it hold 0.6. But I think that was maybe the reason for the weakness in the financials today. And the materials, which have had a very good month, were down 2%. The metal and that would probably include the metals and mining stocks. Gold was down 1%, breaking a multi-day rally and silver was off a little bit more than that, maybe down 3 or 4%, but still holding the $23 level. Hello, McLiberty. Nice to have you with us this evening. Okay, so um, I think what everybody really wants to talk about today is the earnings that we had after the close from the four horsemen of the technology field. No disrespect to Microsoft, of course, but Google, Facebook, Amazon, and Apple have been four of the key 5 or 6 or 7 stocks that have been driving the big hyper growth momentum trade in Nasdaq, and also to some extent in the S&P. So I'm going to go through these a little bit with some highlights. I just have to reinforce that I am not a registered securities analyst, although I am a registered person in the securities business. I am not recommending that you buy or sell any of these stocks. This is just a recap of what their earnings were and how these stocks reacted in after hours trading following those earnings. I did not listen to any of the conference calls, but I would be very surprised if these stocks do not open very strong tomorrow morning. So we'll start with Google. Google, if there was a disappointment among the four, it came from Google, although they beat their earnings per share quite a bit. They made $10, a little over $10. The estimates were to make a little over $8. Their revenues were 38 billion versus expectations of 37 billion. They had a 24% operating margin, but where they fell short and where some comments came back from some things that the chief financial officer said to a few financial reporters after their earnings was that they were a little disappointed in their ad revenue. That was a touch light. So the stock was really pretty much unchanged the last I looked at it just after 6 o'clock. Obviously, the stock's been a big story, a great success. They have a hyper dominant position in the search market. But there were some stories when they in March that and going into April that advertising revenue was down across the board, even digital advertising or advertising on the internet. So that seemed to have affected Google a little bit. Look, they still had revenue that came in $1 billion above expectations. 38 billion versus 37 billion. This is a world of very large numbers all these companies live in. And they still beat their earnings per share by $2 a share. So, but clearly ad revenue is what drives their business. People saw that just a touch light. And they didn't sell the stock aggressively, but they certainly didn't buy it like they did the other three. Okay, so now Facebook. Facebook had revenues of 18.7 billion. Consensus was for 17.5 billion, so that was a very strong beat by just over $1 billion and even by a higher percentage than what Google beat. Their average daily users, which is a metric that everybody looks at when they look at Facebook, because they want to see how many people are actually using the platform, increased 12% year over year. And their earnings were strong also. For some reason I did not write down exactly what their earnings were, but they were trading up at about 6:15. They were trading up about 10%. So they must have had a very strong conference call, said all the right things, and painted a very strong. And I did hear some comments from a couple of people that are really tuned into the sector that where the advertising revenue for Google was lighter than what they were forecasting. For Facebook, it was in line or even maybe a little bit better. So there's something about ad revenue on Facebook that did not drop off or it dropped off on some of the other social media and internet search platforms. Maybe it was the fact that Facebook was the one company that said they were not going to uh, curtail political advertising like some of the other big companies were. And they got some well publicized pushback by activists that tried to rally Facebook advertisers to put pressure on them. Um, they stood their ground, and their ad revenues were very strong in the second quarter. We gotta watch this stock tomorrow because it was trading up very strongly after their earnings report. Okay, now um, Amazon. Amazon just had a monstrous, ridiculous quarter. The estimates for them were to make about $1.50. They made just over $10. It's people were saying, and I certainly would agree with this. I've never seen anything like this before. The estimates for Amazon were to make $1.50 earnings per share in the second quarter. They made over $10. Now, I don't have all the details right in front of me. I'm not going to be able to break down exactly where they made it, but clearly they got a big hockey stick effect with their revenue because their revenues came in 10% higher than expectations. Okay. They're, they were expected to have $81.5 billion in revenue. They had $89 billion in revenue. That's beating consensus by 10% on their top line or revenue number. It's just it's just a sick earnings report from Amazon. Now, the stock was trading up. The stock went out at like 32.15. Actually, the stock went out just above 3 between 3,000 and 3,100. If I do this right, between 3,000 and 3,100, the stock was up 6%, a little bit after 6 o'clock, trading at 32.50. Remember, the high for Amazon was 33.50 that day that the Nasdaq touched uh, 10,820. It was the same day that it was up 2% in reverse and went down 2%, had a 4% intraday reversal. Um, I mean, Amazon just, they're, even though they're spending a lot of money on their delivery platform, clearly they crushed it in the second quarter while people were sheltered at home, ordering everything from food to consumer staples to toilet paper to paper towelings to bathroom goods to anything you could possibly imagine on Amazon. And I would also mention that UPS reported their earnings before the opening today. They beat their earnings per share estimate by $1. They beat their revenue projection by 13%. The stock was up about 15%. It kept basically single-handedly kept the Dow Jones Transportation Average in the green all day long. And we're talking about a average that is scraping the 10,000 level. It has had the Dow Jones Transportation Average 9,900 ish, a little bit above that maybe, is only traded above 10,000. I think one day in early June, went back down probably 20%. Now it's back. It's obviously with the airlines in the transportation average, it's had a much more challenging time getting anywhere back to where it was during even the first week or two of the sell off because of the heavy exposure that it has to the airline industry. But UPS was up 15% today. Their earnings report was before the opening, and clearly with a lot more deliveries, not just from Amazon, but from everybody, they had a great report. Okay, now, um, some people were maybe looking for some, if there was anything weak at all in Amazon. They don't do the grocery deliveries that some places do yet. Clearly, there's a lot of people delivering groceries online from Fresh Express to a number of others that I don't know the names off right off the top of my head. But Amazon's earnings just crushed it. It'll be fascinating to me to see whether the Amazon can get back near that 33.40 level, which was the high, um, the all-time high for Amazon. Now, Apple. Okay, Apple reported a very strong number. I mean, I'm sounding like a broken record, and I have been concerned that these stocks were priced for perfection, and that these earnings reports from these companies had to exceed expectations plus with a few uh, superlatives on top of it for them to continue the big rally that they've had, not only off the lows from March, but since the beginning of the year and over the last, 2 to 3 years. And I mean, with the sole exception of Google, which was not a bad earnings report, it certainly looks like they delivered. Apple had earnings per share of $2.58. The consensus was for $2.04. That is a beat of 25%. Their revenue came in at 59.7 billion. This is a company that makes phones, tablets, laptops, and apps to put on your phone. They don't make the apps, but they market the apps, and they make wearable devices also. The fancy high tech earpods that go for about $250 a pair, and the Apple Watch. I don't know what it goes for. Uh, their revenue 59.7 billion versus expectations of just over 52 billion. That's not quite a 10% beat like Amazon had, but it's a beat of, I mean, just eyeballing it, of 60 times 7. That's a beat of at least 7% on the revenue number from Apple in Q2. Now, clearly, you can order Apple products online. If your service is Verizon or AT&T or one of the other carriers, you can. And there's definitely people that were updating their laptops, maybe their tablets, maybe their phones, if they were going to do Zoom conference calls from their phone. So I'm sure that there was maybe an accelerated upgrade cycle going on here. But these are just wildly impressive numbers. Uh, Apple was trading up $20 in the aftermarket. That's about 5.5%. It was trading above 400. The old all-time high for Apple was 393. So it doesn't necessarily mean it's going to open that high tomorrow when trading starts at 9:30 in the consolidated market. Trading will start in the consolidated taper on 8 o'clock. But when the Nasdaq market officially opens at 9:30, it doesn't mean that Apple will be above 400. But it seemed to be that they said just about everything right. The other thing that they did, which I really like, which very few companies have done over the last few years, is that they announced a 4-for-1 stock split with the obvious, with the comment, and they did make a comment that they wanted the stock to be more affordable for everyone. Now, they are in the Dow Jones Industrial Average. So the divisor will change a little bit, or what I call the multiplier, where a certain move in the stock, because now Apple will be 100 and not 400, they will adjust that divisor down a little bit because going into uh, uh, right now, and this stock split is not effective till the end of August. So Apple will still be trading high 300s, maybe even above 400 as it was after their earnings report tonight. But I think the 4-for-1 stock split is very important because I would like to see Tesla, Amazon, Spotify trades at $1,000. I would like to see a lot of these stocks that trade well over one or $200 or $300 that are trading at 1,000 or more. I would like to see them split their stock just to make them more affordable for retail investors. Now, I will say that even given that, I realize that there are these that places like there are some brokerage operations that cater to retail that have created this system where you can buy fractional shares. I don't know what extra vig you might pay for that. And it was always that companies used to always split their stock to make them not so ridiculously expensive for retail. Because it used to be if you bought 100 shares was a round lot. And if you bought less than 100 shares, that was called an odd lot. So if you bought 1 share or 10 shares or 20 shares, that had to go through an odd lot facilitation system. And you would pay a little bit extra for that. But with the advent of Reg NMS and electronic trading and everything, I don't really think it matters. I think you don't pay more right now if you're buying less than 100 shares of a stock. And now some companies, with Amazon trading at 3,000 and with Netflix trading at 1,500 and with Spotify trading at and other companies trading between 500 and 1,000 and some even more than 1,000. Some brokerage entities have created this system where you can buy fractional shares. You can say, I want to buy $150 worth of Amazon. I'm sure there's an extra vig for that. They might not really display that in terms of a commission. But I still would like to see a lot of these companies split their stock just because I think to have these single stock prices at 500, 600, 400, 600, 800, 1,000, 1,500. I just think it's ridiculous. Split the stock, have it twice as many shares outstanding. The float's going to be the same. The market cap's going to be the same, but your stock is going to trade a lot better and a lot smoother in the market if there are that many more shares out there and the price is not a either a high 3-digit or a 4-digit stock. So Apple, they split their stock. It's effective the end of August. They crushed it on earnings and they beat their revenue. They beat their earnings projection by 25%. They made 258. They beat their revenue by over 7%. It's ridiculous. It's crazy. And they also said that they had big increase in both their wearable business and their services business. Okay. So that's got a lot to do with the apps on their phone. And the wearables, of course, is the watch and the wireless earpads. So this is just something to watch. We got to watch and see if it holds above 400. That would be new high territory. They got $190 billion in cash. Okay. So, if they wanted to retire all their debt tomorrow, they could. They're not going to. They sold debt at very low rates. And, they want to keep the cash for any purposes that they might need down the road. They've paid a dividend. They recently paid a dividend, or they paid it with this last quarter. It's just been a incredibly successful story that doesn't want to stop. All right, now let's go back. We can talk about, and if you have any questions, I don't, today right now is a good time. Um, and I think we should maybe talk about oil and energy a little bit. Oil was down a little over 2%. It briefly traded below $40. We had mentioned the $40 level as a key threshold level. It closed. I wouldn't say it closed, but at 6 o'clock, it was trading at $40.35. There was a comment from a big oil industry group that International Energy Association, IEA, I believe, that they didn't expect demand to get back to where it was pre-pandemic until 2022. I think that put a little bit of a weight on the price of the commodity today. And also, Royal Dutch Shell did announce their earnings before the opening, and they made very cautious comments about the industry. So they are a big bellwether international oil company based in Europe, obviously. And their comments, in addition to what the IEA said, I think put some pressure on crude today. We'll see if crude holds $40 tomorrow and into the first week of August. I think it's a big level. The energy sector was down 4% today. Exxon and Chevron report earnings tomorrow morning. Exxon and Chevron were each down about 4%. In front of their earnings reports, I'm sure people were anticipating, well, look, Royal Dutch down, 65% on revenue. We're going to see similar numbers from Exxon and Chevron. We'll see. We'll see very early tomorrow morning. My recollection is these companies report very early, like by 7 a.m. So metals pulling back. Yes, they are. The material sector was down quite a bit. We had that big reversal in silver the other day. Tremendous volatility. Not quite as much volatility today, but it was down. It held the $23 level. I think it went out around $23.50, $23.60. Gold was down about $8 or $9. So down a little bit less than what it was up yesterday. I still have this feeling that gold is going through 2000. But look, it's a big round number. It's a big threshold level, and it may take, some more conviction from the buy. I also think the dollar was maybe, if the dollar was not a little bit stronger today, it had halted its slide to the downside. And the big rally, I would say 3/4 of the rally in gold and probably silver has been due to the weakness in the dollar. Because it will trade within gold will trade with a inverse relationship to the dollar frequently. So if you're trading gold and or silver or just watching them, I would also watch the US dollar. You can watch it as the DXY, which is a dollar basket, or just watch the euro. And if the euro's up, the dollar's probably down. And if you can watch the British pound and the yen, those are the three main currencies to watch against the dollar. So Where else are we? There's a couple other things we can talk about. So the GDP numbers came out today, and I was commenting a number of times that uh, I thought it would be high 20s, a little bit better than expected. The estimates were for down 35 in the second quarter, uh, but it came in down 32.9. Now, uh, basically, consumer discretionary spending was down 29%. I found that very interesting. Industrial activity was down much more than that, down 50%. Okay. So you got the consumer 70% of the economy. Consumer gross domestic spending was down. Uh, I think it was down about 29% or 32%. I don't want to look it up right now. I don't want to distract, but it was. And then you had um, the industrial activity down about 50%. Now there's this component of GDP called final sales. Final sales was down 29 percent, very similar to what we saw from American Express when they reported a week ago that AXP down 29%. That's what you call a bellwether indicator because that was the final sales number in the GDP report. The reason that the GDP was down 32.9 and not just the 28 or 29 from final sales was industrial uh, output was down about 50%. Now, we had a number of other, we still got a few minutes here. We had a number of other very interesting earnings reports early today. I'll just run through them kind of quick. InBev, which is Budweiser and a few other foreign beers. Second quarter revenue down 26%. Um, Molson Coors did a little bit better, only down 15%. Um, there were a lot of cynical jokes about, well, of course, the liquor stores are still open during the pandemic. Everything's shut down but the liquor stores. They're an essential business. You can get different comments on that. But look, the Budweiser sales for the second quarter down 26.3%. Kind of in that ballpark of what we saw from Coca-Cola, what we saw from McDonald's, and what we saw from American Express. That's a big, big, big component of consumer spending. So now, a few days ago, we had earnings from Starbucks. I think their revenues were down 21 or 22%, a little bit less than expected, and the stock got a big bump. Somebody on the chat here, might have been you, Pablo, I can't remember, mentioned, I like Dunkin' a lot better. Well, Dunkin' reported this morning their revenues were down 20%, a couple percent better than uh, Starbucks. I did not check to see what the stock did. Now, International Paper. This is basically a company that would be in the materials index. Uh, their revenues were only down 14%. But if you want to think about how much stuff everybody ordered to be delivered to their house and talk about corrugated boxes and shipping and cardboard, International Paper did a little bit better than, not quite as good as the big tech companies, but their revenues were only down 14%. Procter and Gamble, clearly a consumer staples company. What do they sell? Toilet paper, paper towels, the stuff that all the grocery stores sold out of very, very, very quickly when the shutdown came. Their revenues were plus, and toothpaste, et cetera, et cetera. Basically, your ultimate consumer staples company. Their revenues were up 3.5%. So we have a great question here in the chat from Jen. Are we looking for a bad jobs report coming? Well, we did have a jobs report today. That's the other thing that we should talk about. And we had the weekly first time unemployment claims. And that's one of the reasons the market started so sharply to the downside today. I got to kind of find where I wrote it down. I think I wrote it down somewhere. Yes. And it was not really a good report. It was for last week's activity. And clearly, last week was maybe the peak of the virus, causing a halt in a lot of companies reopening, and then maybe even causing some workers that have been called back to work to be laid off again, and a delay in rehiring some other workers. But first time jobless claims were at 1.43 million for the prior week. That's above that 1.4 million. They had run like 1.3 for 2 or 3 weeks. And the continuing claims number came in pretty much unchanged with last week at 17 million. But the expectations were for that to drop close to a million to like 16.2. So the question is, are we heading for a bad jobs report? I would guess that you're talking about the July jobs report, which will come out next Friday. So we added jobs last month. We added jobs the month before. Both of them were surprises to the upside. I'm going to try to get a better read on this early next week. It's going to be hard for us to add jobs in in the month of July, given the fact that the declines in the weekly first-time jobless claims pretty much leveled off at down 1.3 million for the week, and now it's ticked up a little bit. Although I will say that the way the weekly jobless report works, the survey week was the second week of July. Okay. So that was the week. Let me see. Tomorrow is the 31st. So that was the week where the Friday was the 14th. It was not the week of the 4th of July, but the first full week after that. That was the survey week. And I think it might not be as bad as it would have been if the survey week was. What they do is they survey 60,000 households. Were you working last week? What were the circumstances? California. Yeah. Well, look, part of it is that you have legitimately had a bounce back, unfortunately, to the upside in the amount of coronavirus cases. Not nearly so much with the hospitalizations and the death rate, but there's been a tremendous amount of testing, and there's been a lot more positive tests, and clearly there's been incidences of huge crowd behavior from time to time that has probably also spread the virus in I'm not going to call it the second wave, but another resurgence of virus cases, maybe a little bit more than people would have expected. I would say that it's not going to be I don't know that we're going to have a huge decline in job losses, but I doubt that we're going to have significant job gains for the month of July, which we really need. It seems to me that maybe this week there's been a lot. We're getting some indications that the virus count has peaked or is peaking. Still a couple of hot spots, not quite to the extent that we saw 2 weeks ago. That report comes out next Friday. I'm sure there will be a lot of anticipation going into that report as to how they're going to, what they're going to have to say. So, couple of other companies that I thought were interesting. Yeah, Royal Dutch revenue. Royal Dutch is a big international oil company. Revenue down 65%. Valero revenue down 65%. It's almost exactly the same revenue drop from what we saw from Royal Dutch Shell. It'll be very interesting to see if Exxon and Chevron hit that same number tomorrow. I mentioned UPS, United Parcel Service. That was a great earnings report from them. The stock acted very well. We'll see. We'll have to see if Apple, Amazon, and Facebook can act as well as UPS did, up 15% today following their earnings report. Um, One other report that I thought interesting, MasterCard reported early before the opening today. They beat on revenue by a little bit. They had revenues of 3.3 billion. I think estimates were 3.2. They beat quite a bit on earnings per share. Uh, they made $1.36. Expectations were for $1.16, but that earnings per share versus second quarter last year was down 27%. Their revenues were down 20%. I'm not sure what their mix is vis-a-vis American Express, but yes, their revenue decline was a little bit better than American Express, a little bit less steep. Yes, that's what I was trying was what I was going to get to earlier, Jen. So states like California um, are kind of taking a double hickey here from virus count going up and Dems being and Democrat governors and some Dem local officials, although there's some pushback from Orange County from what I've seen, just being ultra conservative, if you want to put it nicely, or draconian, if you want to put it harshly, on uh, mandates of shutdowns of businesses, et cetera, et cetera, et cetera. Now you've seen that in pockets in Texas, even though you've got a Republican governor, Greg Abbott. You've seen that in areas of Florida, which have had really extreme outbreaks with actually some higher death counts um, in Southeast Florida. And we just got to, I do think that the comments that Powell made in his presser Wednesday afternoon were spot on. That the key to getting the economy to take its next leg up is beating the virus, because you're not going to get businesses back above 50% capacity. You're not going to get people comfortable going to restaurants opening, or people comfortable going to restaurants, people comfortable traveling on airplanes, people comfortable going to hotels, going to events, until you beat the virus. Now, the market seems to have confidence that the virus is going to be beat and that the economy is then going to recover rapidly. The market has had a very sharp U shaped rally off the lows in March. And I would say that the economy has had a good chunk of of a V-shaped. I meant V-shaped when I talked about the market, of a V-shaped recovery. We might plateau for 4 to 6 weeks, and then we got to take that extra level up. Um, so, and that will come, I think, with the process of beating the virus. And I also think that where it's going to be state by state and locality by locality, and I know the teachers union are trying to make a big political statement or stand on this, but a big key to getting businesses back, people get back to business, is getting the schools open. So it'll be interesting to see how that part of the equation uh, plays out. Yeah, Jen, I have seen reports on that from Orange County. I think we've had a little bit of that, a highly publicized case of that with a gym in New Jersey. I was an hour and a half south of here in New Jersey on Tuesday, and there were some bars and restaurants that were serving outside, um, not really with the total restriction that meals had to be consumed also to be served drinks. Although I will say that there were not hundreds of people in attendance at the establishment I was at, but um, there were a couple of dozen um, locals at a place that was maybe a little bit under the radar. Uh, but I think that that's going around a little bit, and I think that that is good. I agree with you. So, look, tomorrow is a big day for the market because we had just tremendous earnings from Amazon, Apple, and Facebook tonight after the close. The stocks were all up in response. The S&P 500 futures were trading up 15 points in the aftermarket. The last I looked, a little bit after 6 o'clock. Unless they are extremely cautious in their conference calls, I would expect these stocks to open higher, significantly higher, like 5% or more tomorrow. And then it will be a question of whether the big holders sell into that rally like they sold into Amazon when it got to 33.40 on the day that NASDAQ had its 4% reversal. They sold into Amazon hard that day, saying that, look, this is just a little bit too much now. This, I get it. They're crushing it, but the stock's at 33.40. It's crazy. It will be interesting to see if some of them, if the momentum investors sell into this now, given that we have new data points and that these companies not only beat earnings projections, which they really had to do just to maintain their current price level, but they beat them. They just crushed them with extra superlatives on top. The people and it's, can they duplicate that next month? Probably not, but never say never. And you're gonna have, it's going to be a real gut check to see if the market really can take another, leg after this big move that it's had, given that some data points on the economy aren't following through with as much gusto yet. And keep in mind, we're going to get earnings tomorrow morning from Cat Tractor, member of the Dow Jones Industrial Average, huge exposure to China. Uh, Exxon, Chevron, the number one and number two global energy uh, multinational, you know, exploration and refining companies. Um, and whether or not they feel that, how they feel about the future, if they're as cautious as Royal Dutch Shell was today. Um, Keep in mind that Royal Dutch Shell, I don't know if I have this written down or not. Royal Dutch Shell did cut their dividend in April. It's the first time they'd cut their dividend in 80 years. So that would be like going back to 1940, just before going into World War II. Royal Dutch Shell eliminated their dividend during the war years. Now, again, they are based in the Netherlands, and things were, this was ground zero for the ground war in World War II. But they did suspend their dividend from 1940 to 1943 They After the war, they reinstated it. I'm sure they increased it numerous times. This is the first time they've cut their dividend in 80 years. Exxon has not cut their dividend since 1948. I'm not sure what happened in 1948 exactly that they made a dividend cut. I think there was a little bit. We had a big boom in the economy after World War II ended. And then we had a little bit of a recession in 48, 49. I'm not sure exactly what was going on with Exxon away from that. Chevron has not cut their dividend since 1934, the absolute worst of the worst dregs of the Great Recession. Okay. I'm not sure when they reinstated it. I don't know if they reinstated it and were paying it during the war or not, but they have not cut their dividends since 1934. Chevron particularly kind of uses a little bit of a badge of honor. I think there's been much more speculation that Exxon might cut than Chevron because the yield is so much higher, but we'll have to see. I'm not predicting that one of them is going to cut tomorrow, but it's something to keep a watch on. So, yeah, in Pennsylvania, they're really upset with Wolf. I know that. I mean, I've heard Adam talk about it numerous times. And just to make it worse, the liquor stores are all owned by the state and they were shut down while the state offices were shut down. Yeah, some barber shop in Huntington Beach. HB's got to be Huntington Beach, right? Moved its chairs out back. A couple of these gyms in New Jersey have tried to move all their equipment outside, but you can imagine moving gym equipment outside and then back in at the end of the day is a lot of work. Yeah, healthcare is stuck here a little bit. I think that healthcare is look, there's a lot of cross currents in healthcare. Some of them are. I think that Trump is gonna be steadfast about this reduction of prescription prices. Unlike when he gave in to everybody that was pushing back hard when he first went at this about 18 months ago or a little bit longer. I don't think he's going to back off on it now. And I think that healthcare has issues and obviously a tremendous amount, just a ridiculous amount of political risk for healthcare going into the election. Every sector has major political risk for this election, but healthcare probably as much as any other. So look, I don't have a whole lot else right now. It's good. We're coming up on 8:00 pretty soon here. I really want to thank everyone for their support. Thank you for watching. If you're watching and you have not subscribed to the channel yet, please subscribe to The Anderson Report on YouTube. Hit that little bell next to it, and you'll get notifications on when our next broadcast is. Tomorrow is Friday. I will most likely not have a broadcast tomorrow evening. I'm 50-50 on Saturday morning. But I will at some point in time have a month end recap. If not Saturday, sometime on Sunday. I'll put it out well in advance on where how we came out of July. It looks like we're going to have a positive month for all the major averages, and but I'll do a month end recap at some point in time over the weekend. Before we get into the first week of August. So closing in on first 100 subscribers. Hey, that would be great. And thank you, everyone. This is the Anderson Report. Thanks for watching. And seriously, especially the people in the chat, thank you for your questions. Thank you for the questions you shoot me on Twitter. And have a pleasant evening.